In the year 1929, the US stock market fell 89%, and almost nobody saw it coming. In 2000, the dot-com bubble erased $5 trillion in wealth, yet the warning signs had been visible for years. In 2008, the housing market collapsed so violently it triggered a global recession. And still, the experts said everything was fine. Today, in 2026, the data is showing the exact same fingerprints. The same debt buildup, the same inflated asset prices, the same investor psychology, the same global fragility. History isn't repeating, it's rhyming. And the next verse has already begun. When people hear the phrase economic collapse, they picture doom. They picture flashing red tickers, headlines warning of catastrophe, and entire nations bracing for impact. They imagine the stock market plunging, banks trembling, and ordinary families waking up to a future they never prepared for. That's the surface story, the one everyone sees. But beneath it lies a secret that history whispers again and again, a truth buried beneath centuries of fear and speculation. The truth is this: every collapse you've ever heard of wasn't merely a disaster, it was a doorway, a shift, a transfer, a moment when the world quietly rearranged its wealth, its power, and its future direction. And the people who understood this, not the lucky ones, not the geniuses, but the ones who paid attention, didn't just survive. They emerged with wealth, influence, and advantage that would last generations. This pattern is not modern. It didn't start with Wall Street or the Great Depression or the dot-com bubble. This pattern is ancient. When Rome's currency collapsed under hyperinflation, senators bought entire estates for the price of a loaf of bread. When the Byzantine Empire faced a massive monetary crisis, gold-hoarding merchants rose to become the city's shadow rulers. When Venice endured financial panic in the Middle Ages, the trading families who had prepared in silence acquired entire fleets for a fraction of their value. The cycle repeats across millennia, continents, and civilizations. The names change, the technologies change, the flags change, but the pattern remains the same. Every great crash becomes the beginning of a great redistribution, not of destruction, but of ownership. The world remembers the panic, but it forgets the opportunity. After the crash of 1929, the investors who bought during the darkest hours saw returns so enormous they barely seem real today. After the dot-com collapse, when internet companies evaporated overnight, the patient few scooped up shares of Amazon, Apple, and Nvidia at valuations so low they seem fictional. After the housing market imploded in 2008, when it felt like the entire financial structure was disintegrating, it was actually the start of the longest bull market in American history. This script isn't about fear, it's about understanding a cycle older than modern finance itself, and learning how to stand on the right side of it. Because today, right now, we are standing at the edge of another turning point, and what's coming in the next few years will not be a small dip or another routine correction. If history is a guide, and it always is, we are approaching something much bigger, a moment that will shift the financial landscape as dramatically as 1929, as violently as 2008, and as permanently as every collapse before them. But before we talk about what's coming, we need to understand how collapses actually work. Not the surface level explanation, but the deep structure behind them. Most people think crashes destroy wealth, but that's not true. Wealth doesn't vanish. Yes, numbers disappear from screens. Yes, valuations fall to the floor. Yes, portfolios turn red. But real wealth, the kind built on land, resources, businesses, innovation, doesn't evaporate. It simply changes hands. The unprepared lose it. The prepared gain it. It's not magic. It's not luck. It's a cycle. And this has been happening long before markets were digital, long before governments printed money by the trillions, long before analysts existed to predict the unpredictable. In the 1600s, when the Dutch tulip mania collapsed, fortunes vaporized overnight. But while thousands were ruined, a handful of merchant families, the ones who stayed patient, who kept liquidity while others were drowning in speculation, acquired warehouses, ports, and ships at prices unthinkable mere months before. During the South Sea Bubble in 1720, the entire British financial system was shaken. Share prices crashed 90%. Investors lost everything. Yet the aristocrats and banking families who had quietly built cash reserves were able to acquire prime land, mines, and trade monopolies for a fraction of their true value. In the Panic of 1873, railroads, the backbone of the American economy, collapsed under massive debt. But the investors who stepped in during the panic became the industrial titans of the Gilded Age: Carnegie, Rockefeller, Morgan, Vanderbilt. Their legendary wealth wasn't built during stable times. It was built during chaos. This isn't conspiracy. It's not a secret club. It's simply how economic resets work. And now, more than a century later, the same pattern is forming again. Debt is rising. Speculation is rampant. Asset prices have detached from reality. Governments are printing faster than economies can grow. Every indicator that has preceded major collapses, every warning sign that historians look back on and say, how did they miss this, is glowing red. But here's the twist. Even now, even as the signs flash, most economists are saying everything is fine. They said it in 1929. They said it in 2000. They said it in 2007. And every single time, they were catastrophically wrong. Meanwhile, the smartest investors in the world, the ones who move silently, are preparing, not panicking, preparing. Buffett is sitting on a historic mountain of cash. Hedge funds are building positions in commodities. Sovereign wealth funds are shifting into real assets. Central banks are hoarding gold at the fastest pace in over 50 years. Why? Because collapses don't reward panic. They reward preparation. And preparation starts with understanding the deeper cycle, the one playing out beneath the news headlines and quarterly reports. The cycle economists call the long-term debt cycle, or the 18 to 20-year reset, or the systemic correction phase. But names don't matter, history matters. And history shows that every few decades, the same combination appears. Asset prices rise faster than incomes. Debt grows faster than the real economy. Governments borrow to cover deficits. Consumers rely on credit to maintain lifestyles. Corporations finance growth with cheap loans. Investors fall in love with risk. This is the build-up phase, a period that feels stable, prosperous, optimistic. A period where people believe this time it's different, where speculation becomes normal, where bubbles inflate quietly in the background. Then something shifts, a trigger, a spark, a small fracture that reveals how fragile the system really is. Sometimes it's a bank failure, sometimes it's a policy mistake, sometimes it's global tension, sometimes it's inflation spiraling out of control. People blame the trigger, but the trigger isn't the cause. The cause is the years of excess that came before it. That's why crashes seem sudden, violent, unexpected, but to historians, they're inevitable. And right now, today, we are living in the build-up phase, the period of maximum complacency, maximum leverage, and maximum risk. This isn't fear-mongering, it's historical pattern recognition. But here's the part most people forget. The moment of collapse is never the moment of opportunity. The moment of opportunity is the moment before. That's the moment we're living in now. Before banks collapse, before markets implode, before governments scramble, before the panic begins. Because when the panic begins, it's already too late. History rewards the ones who move during calm, not during chaos. But what exactly is coming? What will the next collapse look like? Will it resemble 1929, 2000, 2008, or will it be something entirely new? To answer this, we need to go deeper into the mathematics, the psychology, and the historical cycles that have shaped every major economic reset in the last 1,000 years. Now that we've uncovered the pattern behind every major collapse, we have to look at the deeper forces shaping what's coming next. Forces that have appeared almost identically across hundreds of years of financial history. Because collapses aren't random. They aren't acts of economic weather. They follow a rhythm shaped by debt, psychology, and time. And one of the most important ideas in all of economic history was introduced by a man named Minsky. Minsky discovered something simple but devastatingly accurate. Stability leads to instability. Whenever an economy experiences long periods without crisis, when markets grow, when jobs are stable, when credit is easy, people start taking bigger and bigger risks. Why? Because they think the good times will last forever. This is how every bubble starts. Not with wild gambling, not with corruption, not with stupidity, but with confidence, with optimism, with the belief that prosperity is permanent. During the roaring 1920s, people believed the stock market would never crash again. During the 1990s, people believed the internet would create infinite wealth. During the mid-2000s, people believed housing prices could only go up. During the 2010s, people believed central banks could print money forever without consequences. They weren't stupid, they were human, and humans follow predictable psychological cycles. This is Minsky's cycle, and right now, we're in its most dangerous phase, because after excessive optimism comes excessive debt, and after excessive debt comes fragility, and fragility only needs one spark to collapse. But here's what's even more fascinating. This cycle doesn't just happen at the level of individuals or corporations, it happens at the level of entire civilizations. Take the Roman Empire. For decades, it enjoyed stability, wealth, and growth. Then confidence turned into arrogance. Arrogance turned into overspending. Overspending turned into debt. Debt turned into currency debasement, the ancient equivalent of money printing. And once the currency fell, the empire followed. Fast forward 1,000 years. The same thing happened in the Abbasid Caliphate, in Ming Dynasty China, in the Ottoman Empire, in the French monarchy before the Revolution, in the Weimar Republic, in post-war Britain, in 1980s Japan. Different cultures, different political systems, different eras, same cycle. Because money changes, technology changes, borders change, human behavior does not. And the more we understand this, the more clearly we can see the present. Look around the modern world. Debt has ballooned to levels no previous civilization has ever reached. Governments are borrowing as if tomorrow doesn't exist. Corporations are refinancing debt just to stay alive. Consumers are living on credit to maintain their lifestyles. Asset prices have soared far beyond their fundamentals. This isn't prosperity. This is the late stage of a long, predictable cycle. And the economists who reassure you that everything is stable, they said the same thing before every historical collapse. Because experts don't predict crashes. Experts justify bubbles. So where are we in the larger arc of history? To answer that, we need to look at another extraordinary theory. One introduced by a Russian economist named Nikolai Kondratiev. Kondratiev believed that economies move in long, multi-decade waves, large cycles of expansion, innovation, peak, decline, and reset. These cycles last roughly 40 to 60 years. A typical Kondratiev wave looks like this: spring, recovery from crisis; summer, rapid growth; autumn, speculation and bubble winter; collapse, debt destruction, reset. And guess what phase we're entering? Winter. This isn't speculation, it's statistical, it's historical, it's mathematical. Our global economy, especially the US financial system, is deep into the autumn phase. The phase of speculation, financialization, inflated assets, and dangerously cheap debt. And the transition from autumn to winter is always the same: a credit crisis. Because when an economy becomes addicted to cheap money and easy credit, all it takes is one shift: a rise in interest rates, a decline in liquidity, a geopolitical shock for the structure to crack. And once cracks appear, confidence evaporates. And once confidence evaporates, the cycle resets. But reset doesn't mean destruction, it means redistribution. Every Kondratiev winter in history has led to massive wealth transfers, from weak hands to strong hands, from debtors to creditors, from speculative assets to real assets, from overvalued markets to undervalued opportunities. This is why the coming downturn matters, not because of the pain, but because of the opportunity. And right now, we are on the edge of something enormous. Every major indicator, from consumer sentiment to manufacturing data, from corporate earnings to national debt, from interest rate pressure to global tensions, is saying the same thing. A global economic winter is coming. But here's a twist that history reveals. The people who panic during winter lose. The people who prepare during autumn win. And the people who act during the deepest moments of winter become wealthy beyond imagination. But before we get to how to prepare, we need to understand why our modern world is especially vulnerable. Because unlike previous cycles, today's financial system isn't built on stable foundations. It's built on debt. Debt built on debt, debt multiplied by derivatives, debt amplified by years of money printing. After 2008, central banks created trillions of dollars to stabilize the markets. After 2020, they did it again, but on an even larger scale. This temporarily inflated the economy, but in doing so, it created a much larger bubble, one that affects everything: housing, stocks, bonds, crypto, commodities, and even currencies. And history tells us something chilling. The bigger the bubble, the bigger the collapse. But here is the most important part. The collapse is not the end. It is the beginning of a wealth transfer unlike anything in modern history. Because when the dust settles, the world will not look the same. Currency values will shift. New technologies will rise. Geopolitical power will realign. Entire industries will disappear. Debt-fueled valuations will crumble. Real assets will become king again. And the people who understand what's coming, who understand how cycles work, who understand how wealth truly behaves, won't just survive. They'll thrive. So what exactly does a global economic winter look like? How does it begin? What are the signs? And most importantly, how do you position yourself on the right side of it? To answer that, we need to look at the cracks already forming in the foundation. Cracks that no expert, no politician, no central banker can hide. Cracks that signal the beginning of the reset. To understand the next stage of what's coming, we have to step deeper into the patterns that history leaves behind. The patterns that reveal not just how collapses begin, but how they transform the world that comes after. Because here's the part almost everyone forgets. Crashes don't end systems. They reshape them. They redraw the map. They expose the illusions. They reveal who was truly strong and who was only pretending. And right now, the illusions holding up the global financial system are fading. Household debt is rising faster than wages. Corporate balance sheets are swollen with loans that were only manageable when interest rates were near zero. Governments are rolling over trillions in debt into higher interest environments, the economic equivalent of trying to surf a breaking wave. And beneath all of this lies a truth that no central banker or politician can escape. When debt grows faster than the economy, the crash becomes inevitable. Not because of politics, not because of ideology, not because of news headlines, but because of mathematics. Mathematics doesn't panic. Mathematics doesn't negotiate. Mathematics simply waits, and then it snaps. And when it does, the illusion breaks. That's exactly what happened in 2008, when mortgage debt grew faster than real incomes. It happened in Japan in the 1990s, when real estate prices detached from reality. It happened in the 1970s when inflation spiraled out of control. It happened in the 1920s when leverage turned optimism into disaster. And today, the cracks are everywhere. Consumer confidence is weakening, manufacturing is slowing, credit card defaults are rising, corporate bankruptcies are quietly increasing, commercial real estate is on the edge of a historic correction. Global tensions are pushing supply chains into uncertainty. But here's the critical part. Most people only react when the headlines finally scream crisis. By then, it's too late, because the true moment of danger and opportunity happens before the headlines. During the final phase of the buildup, during the quiet stage, during the time when everyone insists everything is fine. This is the moment in the cycle when the smart money steps back and the unprepared walk straight off the cliff. But here is where the story turns, because this next part is the most important. Crashes don't destroy real value, they reveal it. Think about it. When a stock collapses, the company's factories don't vanish, its employees don't disappear, its customers don't evaporate, its innovations don't disintegrate. The price collapses, not the value. That's a gap where wealth is transferred. It happened when Amazon fell from over $100 to $6. It happened when Apple traded below cash value. It happened when Netflix was treated like a failing DVD company. It happened when Tesla was dismissed as a fad. It happened when Nvidia was a niche chip maker ignored by Wall Street. These weren't lucky guesses. They were moments when panic overshadowed reality, and disciplined investors stepped in. But this pattern goes far beyond the stock market. It happens in real estate. It happens in bonds. It happens in commodities. It happens in currency markets. It happens in entire nations. During the Asian financial crisis of 1997, real estate collapsed across Thailand and Indonesia, but the investors who bought at the bottom saw gains that reshaped their entire family's futures. During the European debt crisis, when Greece, Portugal, and Spain were on the brink, assets were sold for prices unseen in modern history, and those who bought quietly made fortunes. During the Great Depression, when banks were failing and breadlines were forming, John D. Rockefeller was accumulating assets when blood was running in the streets. This is the ugly truth. Crashes are painful for those who are unprepared and unimaginably profitable for those who are disciplined. But discipline requires something rare, something almost unnatural. You have to act when everyone else is afraid. You have to stay patient when everyone else is greedy. You have to prepare when everyone else is celebrating. You have to buy when everyone else is selling. And to do that, you must understand what assets actually survive financial storms. Because not everything rebounds. Not everything recovers. Not everything returns to its previous value. History reveals 3 categories of assets. Category 1, illusions. These are assets built on hype, leverage, or temporary trends. They collapse and rarely come back. Examples across history. Railway speculation in the 1800s. Internet startup mania of the late 1990s. Mortgage derivatives of 2006. Meme stocks and highly speculative ventures of recent years. These collapse and never return. They vanish, and so does your wealth if you hold them. Category 2, survivors. These assets fall hard during crashes but rebound because they are useful, profitable, or essential. These include blue chip companies, productive farmland, energy assets, industrial commodities, major banks, post-consolidation, essential infrastructures. These provide stability and eventually recovery. Category 3, wealth multipliers. These are the rare opportunities that crash temporarily but rise far above their previous highs. Think Amazon after 2000, Apple after 2001, Nvidia after 2008, real estate after 2009, commodities after currency wars, precious metals after inflation waves. These are the once-in-a-generation assets, the ones that turn disciplined investors into wealthy investors. But here's the part that makes people uncomfortable. These opportunities only exist because others panic, and they only transfer wealth because others are unprepared. History is brutal. History is honest. History doesn't care about feelings or opinions. History simply rewards those who understand its rhythm. And understanding that rhythm requires one last piece. A piece most people completely ignore. It's not debt. It's not interest rates. It's not inflation. It's not politics. It's psychology. Because every crash in history, every single one, follows the same emotional timeline. Stage 1, optimism. The economy is strong. Stage 2, euphoria. This time is different. Stage 3, anxiety. Something feels off, but it'll be fine. Stage 4, denial. This is temporary. Stage 5, fear. Should we sell? Stage 6, panic. Sell everything now. Stage 7, capitulation. I can't take it anymore. Stage 8, despair. It's all over. Stage 9, opportunity. Everything is undervalued. Stage 10, recovery. Why didn't I buy? This psychological cycle repeats across centuries. It happened in 1720, in 1873, in 1929, in 2000, in 2008, and it will happen again. The only question is, where will you be on that curve? In the panic or in the opportunity? Because the next downturn won't just test your money, it will test your discipline, your patience, your courage, your understanding of history. But here's the final truth, the one that ties everything together. The next crash will not destroy your future. It will define it. If you freeze, it will hurt you. If you panic, it will break you. If you follow the crowd, it will swallow you. But if you understand the cycle, if you prepare ahead of time, if you stay calm when others lose control, if you keep cash when others burn it, if you buy quality when others sell trash, then you will be standing on the right side of the greatest wealth transfer of your lifetime. Crashes are not the end. They are the beginning of new empires, new fortunes, new opportunities. The greatest investors in history knew one simple truth. Wealth is not built in the boom. Wealth is bought in the bust, and the next bust, the next reset, the next historic shift is coming whether you're ready or not. So prepare, study history, learn the patterns, build your strategy, stay disciplined, and when the moment arrives, act with clarity, not fear. Because the people who change their lives during a collapse are not the loudest, not the luckiest, not the smartest. They are the most prepared. If this opened your eyes, if this gave you perspective, if this made you think differently about what's coming,